first, the market impact. Siva, I mean, you outlined it. The bonds have seen a big sell-off. I was just looking at the timelines. We were about 100 basis points lower April last year. We are now at 7% circa. There's a talk of maybe moving to 8% come next April as well. My question to you is, as things stand right now, how swift do you think the movement in yields and rates could be, considering the global picture too? And how swiftly would the Reserve Bank of India thereby have to move now that they've kind of done this change in stance?
It's very, very important not to draw straight lines in these market conditions. So a little over a year ago, we were at about 570, 580 on the 10-year, and now we are a little over 7%. Just to put that number into context, now we are back to where we were in early 2019 in terms of where the 10-year yield is. And back when you're talking about early 2019, which means at the start of the last rate cut cycle. So the market has essentially not just erased the rally which was seen during COVID, but actually has gone back to almost to the start of the last rate cut cycle. So the market in that sense has already priced in a lot of what RBI is likely to deliver. And if you look at, in some sense, the forwards, calculated forwards, obviously we don't trade like the US and other countries, we don't trade, there's no traded market on RBI forwards, but if you implied forwards, essentially suggests that within the next 2 years, we are looking at least 6.5% on the repo rate, if not higher than that. So that's already priced in. And what that means is that unless the RBI surprises either with a significantly faster pace of rate increases or signals that the end of the total magnitude of rate increases will be more than 200 basis points. One of these needs to happen for there to be a significant sell-off from here. Otherwise, any upward pressure on yields is more likely to be transitory in nature because of things like fiscal deficit. There's going to be a relentless supply, 30,000 crores plus per week of GSEC auctions plus SDL. So that is going to keep pressure on rates. But from a monetary policy perspective, I would say that most of the pain is here already. The rise in yields by, let's say, more than 120, 130 basis points from the lows largely reflects the expected change in monetary stance over the coming, let's say, year to 2 years. I'll also add that the curve is not going to behave parallelly at all points of the curve. Is not going to rise by the same amount. So long bonds have already seen a significant amount of sell-off. In fact, today, yields at the shorter end of the curve have risen more than yields at the longer end of the curve, which is normally what happens in a rising interest rate scenario. The curve tends to flatten. It's called bear flattening, where short yields rise more than long yields. And I think that is likely to go on for quite some time, as the curve in India is actually very, very steep. So what that means is that longer end of the curve, let's say beyond 5 years, 10 years and beyond, have already priced in a lot of what RBI is likely to do. Perhaps it's the 1 to 5 year segment which may see more sell-off as compared to the longer end of the curve.
Okay, and we'll talk about the investment implication at the end of it. Trust me to bring that up, Siva, for sure. But just one quick follow-on. Am I understanding this correctly? You believe that unless something really dramatically changes, the yields as they've moved thus far are kind of pricing in most of the near-term parameters?
Yeah, I mean, if you go back to January, February 2019, before the first rate cut of the last cycle, we were at about 7.25. So, yes, can yields rise by another 10, 20 basis points? For sure it can. But for yields to, let's say, to go to 7.5 or 8, the question is where you started from, that requires a major rethink of where the inflation, for example, will inflation average at 6%? I mean, it's a serious question because for the last 2 years, average CPI has been about 5.7, 5.8. The RBI forecast average CPI for the next year at 5.7. So come this time next year, we could potentially be looking at a scenario where 3-year average inflation is 5.7%. Now, if the market begins to believe that the RBI has changed its thoughts around what the inflation target should be, I mean, just put this into perspective. If inflation for the next 10 years will average at 4%, then 10-year GSEC at 6% makes sense. If we believe that the next 10-year average inflation is going to be 6, then obviously 8% GSEC makes sense. If you believe that the 10-year average inflation will be closer to 5, then 7% makes sense. So today with the 10-year at 7%, it largely what the market is telling you is that on average inflation probably will be closer to 5. So the question is whether RBI reclaims that credibility around that 4% inflation target or not, and how soon they can achieve that. If the sooner they achieve it, I think the more the markets will be happy.